Hi everyone, this is Matt. This is Connor with Connor Management Group, and today we are going to go over a presentation called How to Build Wealth and Avoid a Stock Market Collapse. I've noticed that there seems to be quite a bit of concern on both of these topics, and I saw a way to present them in one presentation that I think will be pretty helpful to you. So, on to the presentation, how to build wealth and avoid a stock market collapse. Okay, here in the opening slide, what you see here is some wisdom from a pretty well-known investor. Here are his quotes. Derivatives are weapons of mass destruction. Derivatives lend themselves to huge amounts of speculation. That's Warren Buffett. So derivatives, you may say, is this the right presentation? Well, yes, it is. Just hang with me for a few slides and you'll see why. Derivatives. I don't invest in those. That's what you'd likely say. And I say, well, my friend, I'm willing to bet that you do. Derivatives are usually thought to be all those complex investments that were being sold to mom and pop investors right before the financial crisis back in 2008. Mortgage-backed securities, asset-backed securities, collateralized mortgage obligations, collateralized debt obligations, principal protected notes, variable annuities, all these fancy names, not being clear about what your money is going into. And you know what else are derivatives? Mutual funds and exchange traded funds. Surprised? Yeah, they've been around for quite a while, but they are derivatives. So why are these investment products, even mutual funds and ETFs, derivatives? Because all of these investments are derived, that is derived like the word derivative, from the classic and simple investments known as stocks and bonds. Are mutual funds and ETFs comprised of stocks and bonds, just like complex derivatives? Yep, absolutely. Did people lose money when they invested in mutual funds and ETFs during the 2008 financial crisis? Yep, absolutely. So, is there a safer way to build wealth and avoid a stock market collapse? Well, I'm here to tell you, yep, absolutely. So just what happened during the financial crisis as the market was tanking? Well, all those so-called low-risk hybrid mortgage-based investments became worthless in a hurry, and retirement accounts around the world suffered mightily. When the market collapses in a hurry, the buyers of derivatives either disappear or demand a crazy low price to buy what you're selling. And a noteworthy point, there are always a lot more buyers of simple stocks and bonds than there are of derivatives. So what can you do as an individual saver and investor to build your wealth and avoid a stock market collapse? Get informed. Get informed. So how to get informed? Follow Warren Buffett's advice. Avoid derivatives and buy individual stocks. So, how do you go about doing that? You've got a family, you got a job, you got other responsibilities. Well, the way you go about doing this is by learning about what's called the managed account service. And this is an investment service that was previously only available to the wealthy, but over the last 5 to 10 years, technology advances has recently brought this service to middle-class investors at competitive prices with real advantages. This is a very real and fast-growing service. Just go Google managed account. And after you do that, then what you do is you want to hire an independent money manager, not a financial advisor. Now, this can be a little confusing sometimes, but there's a real difference between a money manager and a financial advisor. But when you talk to them, for the first few minutes, you may be a little confused to say, like, is there a real difference here? And in the notes below this video, I have a link explaining what's the difference between a money manager and a financial advisor for your benefit. By buying individual stocks, your money manager can use stop-loss orders with your individual stock investments. And so if the price of any one of your stock investments suddenly falls by a certain amount, your stock investment will immediately be sold. And by using stop-loss orders, you can avoid the otherwise substantial losses that occur if you are invested in mutual funds or ETFs during a market collapse. Stop-loss orders are generally not available for mutual funds and exchange-traded funds. They're just not available, and for a lot of reasons, you really don't want to have stop-loss orders on those derivative type of investment products. So what are the key advantages of the managed account service? Well, for the purpose of this presentation, first and foremost, you can have your money manager place stop-loss orders in all of your individual stock investments, allowing you to avoid the full impact of a market collapse and therefore protect and build your wealth. Number two, you have full transparency with the ability to see your account positions and balances 24/7. What's great about managed accounts is that you open a brokerage account in your name. You're essentially just giving the money manager electronic permission to invest your funds. And additionally, number three, you maintain control of your account and your investments. So by hiring a money manager that provides a managed account service, you can build wealth and avoid a stock market collapse. If you want to know about managed accounts in general, you can go to my firm's frequently asked page at www.connormg.com. And additionally, you can review the section below this video for some additional helpful links. I hope you found this presentation helpful, and hopefully we'll be talking again soon.